We're living through a period of rising geopolitical tensions, persistent fiscal deficits, questions around central bank independence, and structural shifts in global supply chains. In that kind of environment, traditional portfolio assumptions are being tested. So, where do real assets and commodities in particular fit? Are they simply tactical trades, or do they deserve a permanent place in a strategic allocation? Today, we're joined by Tobias Lazar, Associate Director in Quantitative Research at Wisdom Tree, and we unpack the modern case for commodities beyond just gold. And what does that mean for portfolios in the years ahead? Welcome to the Commodity Exchange, a podcast where we bring you insights from the world of commodities. Whether you're an investor or just want to learn more about the topic, this is the podcast for you. Hey Toby, it's great to have you on our podcast today. Toby, it's your first time on our podcast, so why don't you tell our audience a little bit about yourself?
Yeah, thank you very much, Nitesh, and great to be here. So well, I'm originally from Germany. I studied mathematics at the University of Cologne. I think that was probably one of the hardest subjects you could do there at the time, maybe next to physics. I worked at a startup in Frankfurt after I graduated for a couple of years. Then I decided to do my master's. So I came to the UK, went to one of those great red brick Russell Group universities. I did my master degree there, and did a couple of years of work in London. That's how I got to know many people in the ETF industry, including Robert, and he ultimately brought me over to Wisdom Tree. And yeah, right now I'm working alongside you in the research team with a focus on broad commodities, so commodity ETFs. I'm a chartered alternative investment analyst, so the whole thing's it's really exciting to me. I'm really happy to be on your podcast right now.
Excellent. So Toby is part of the research team at Wisdom Tree, but Robert, who Toby mentioned earlier on, is part of the product development team. So Toby has a wealth of knowledge in terms of ETF construction, and ETP construction, and is now knee deep in doing the research on the underlyings as well as the wrappers as well. So really great to have you on the podcast. Um, so I think today we're going to focus a little bit on the case for commodities, really, um, and maybe we can start off with a key thing that a lot of people grapple with. The question that people try to grapple with is, are commodities a tactical asset class, or do they deserve a permanent allocation in a portfolio? What are your thoughts, Toby?
Yeah, I think that's a great question. I think both use cases are generally meaningful, right? We see in our products that we have at Wisdom Tree that people express their tactical views, right? Their short-term views now, especially with the tensions in the Middle East. There's room to do that. But at the same time, we definitely also see the case for a strategic, right, for a long-term allocation to commodities, right? I mean, many already have that with gold in their portfolio as a protection against like fiat debasement, and also as a safe haven asset. But we also believe that broad commodities, so that is a diversified commodity basket, deserves a place in the portfolio too. And that is because, well, there is a positive expected return. It's a unique risk premia, and thus a low correlation to traditional stocks and bonds. And so, yeah, we can definitely make the case for it as a valuable long-term holding.
Great. So what role do they have as a strategic allocation? What are their behavioral traits that really make them a good for a long term hold in a portfolio?
Yeah, I mean, there are different allocation models, right? There are different philosophies out there. As you know, when speaking to clients, everybody has their own model, so to say, their own belief system. There's top down, bottom up, asset class silos, risk based, the total portfolio approach. right? So there's many ways you can construct a portfolio, but I think what most have in common is that the most important decision is to make the split between the asset classes, right? Because that's explaining the majority of return. And commodities can really play an important role for not for certain mandates. Now, let's say you need to manage risk to a certain degree, right? It's not just about getting the maximum growth. Then you really need diversification, right? And I think we'll come later to that as well. Commodities are really a diversifier. They behave differently than equities or bonds, right? And at the same time, they can preserve purchasing power. And I think this is especially interesting for investors such as family offices, right? Because they have an interest in maintaining their wealth. So overall, I think there are plenty of good reasons why we see commodities as part of the strategic asset class mix.
Excellent. And so a lot of people identify commodities as a cyclical asset class, but equities are also a cyclical asset class. So why not just own equities? What's the point of putting equities and commodities in the same portfolio?
Yeah, that's a great question. And I think it's generally true, right? We see both commodities and equities to be cyclical, but um, the key point to see is that there are different cycles, right? We have equities which rise and fall with economic expansion and fall with contraction, the typical business cycle of recovery and recession. Then for commodities, we also have a cycle, but it's a different one, right? So to just imagine how the commodity cycle work, let's just like walk through it, right? So imagine we have low prices for commodities at the moment, right? And that's generally good for corporates, right? Because commodities are their input prices. So they can offer their products cheaper. That can create a higher demand. That's good for their share price. But at the same time, because commodity prices are low right now, that can discourage investment into new capacity. So, for example, new mines, because in general, you need a certain price level to make it to make your investments worth it. And now, if we see a prolonged underinvestment, that creates scarcity, right? Machinery breaks down, deposits get depleted, which then general means like supply decreases. And if that meets the increased demand, well, that basically means prices have to adjust, prices will rise. Now, with higher prices, you then have lower demand again. And when the new supply comes to market, well, that basically means we have falling commodity prices, right? And that brings us to the beginning of the cycle. And the key to understand is that these two cycles of equities and commodities are independent. They are not in sync, but they're rather complementary. And for example, historically, we have seen that commodities performed well in the late business cycle as well as in the early recession. And so the combination of equity and commodity can add real value, and especially when you otherwise have a very equity heavy portfolio.
That sounds great. That sounds like commodities really do contribute to the diversification efforts.
Absolutely.
Um, I think another thing you mentioned is that commodities can help preserve value, as in it's an inflation hedge. But typically, gold seems to get all the attention when it comes to inflation hedge, especially if you live through the last couple of months. Gold and silver have been right at the top of the list in terms of everything that's being talked about. But how do broad commodities behave in inflationary environments? Is there something different about their behavior?
Yeah, I think you said it right with gold, right? Most of us know it, right? It has this inflation sensitivity, that character, and there's ample of historic evidence to show that. Similar can actually be said about broad commodities, and I'd go even further and say that it's more straightforward to understand, right? Because ultimately, what is inflation, right? It's a change of prices of something like our basket in the supermarket, right? Or the price that we pay at the gas station. So ultimately the gasoline depends on the price of crude oil, right? The price of bread depends on the price of wheat. Chocolate depends on cocoa, right? You see my point. So what we see in general is that commodities, like a broad commodities basket, and inflation typically go hand in hand, right? And so that basically means in inflationary environments, a broad commodity basket can be a real return driver for their portfolio.
Yeah, I agree. I mean, I think gold as a kind of pseudo monetary asset, it does well in inflation environments that are created from, say, maybe too much money supply, right? Money supply increases, that kind of debases the currency, the gold prices go up. But broad commodities, they really represent those shock factors, right? As you mentioned, gasoline at the pump, right? When there's sudden shock to oil supply, gasoline prices will go up. When there's a drought, um, agricultural prices will rise alongside food prices increasing. So, yeah, I think definitely complementary, but I think broad commodities possibly respond to a broader range of shocks than gold on its own. Um, but let's talk a little bit about other things that drive commodity prices. And one of the key things that a lot of people discuss is the U.S. dollar. Um, and people typically say that as the dollar depreciates, that tends to be good for commodity prices. Um, is that right? And what's the dynamics there? What drives that?
Yeah, there's definitely a relationship to observe here. So in general, so we have to understand that the majority of commodities are traded worldwide and are quoted in US dollars, right? But at the same time, and maybe with the exception for oil, the majority of commodities are produced and consumed outside of the US, right? And that basically means that the exchange rate of the dollar has a big impact for producers and consumers as well, right? Because they are ultimately directly affected by that exchange rate. And so why are commodities performing good when the dollar is weakening? Well, this has to do with two effects, right? When the dollar is weakening, first the producers get less local currency for their US dollar traded product, and ultimately that's what they care about, right? Because they're living in a foreign country. For them, that means that it discourages expanding their supply because they just get less for it. And it also encourages them to hold back supply, maybe building stockpiles, right? Um, the second thing is that, well, if there are lower commodity prices in local currency, so all over the world, this incentivizes more consumption, right? So more demand for commodities. Now, if we bring both things together, we have a lower supply on the one hand and a higher demand on the other side. So that basically means prices need to adjust. So we will see higher prices.
Excellent. And so last year, 2025, we had close to a 10% depreciation in the dollar. Um, and certainly we saw commodity prices well supported. Commodities performed relatively well last year. Um, but since the beginning of this year, we've only had about, well, the dollar, looking at the dollar basket, has been broadly flat, if you think from beginning of the year to today. But that masks some of the volatility there. We've had some sharp appreciation and depreciation. And in the depreciation between the middle of January and the end of January was close to a 3% depreciation. Um, how did that depreciation phase fare for commodities? Was it supportive?
Yeah, generally, yes. Yeah, you can say that. I mean, last year, as you mentioned, definitely a special year for the US dollar with that big drop. Um, like if we measure that with a benchmark for commodities, let's say the Bloomberg Commodity Index, the total return in US dollars, then we see it was a good year for commodities with a 16% increase. And yeah, January definitely a volatile month. And so in that second half of January, we saw like a large jump for broad commodities, increasing by 6%, measured by that broad commodity index. Yeah.
Well,
Yeah. And Nitesh, so now, well, we have established what the impact of the US dollar can be. So now turning it around, asking you some questions. What are your views on the dollar? Do you think that it will further depreciate? Um, or do you see like that the recent firming of the greenback will continue?
yeah, I do think there are some structural drivers that could send the dollar lower, as in more dollar depreciation over the next few years. And one of the things I've been looking at is the so-called twin deficit. So a deficit on the current account combined with a deficit in the budget. And um, certainly, current account deficits are wide and are widening, but budget deficits are also uh, increasing as well. If we look at the US, um, we're heading into midterm elections. It's going to be very difficult to rein back spending this year, and unless you see an increase in tax revenue, which is very unlikely given various tax cuts. We are likely to see deficits widen. So that is already happening. Now, this relationship, is a relationship between these twin deficits and the dollar. The wider the deficits go, typically the stronger the downside pressure or the more depreciation pressure we've seen on the dollar. But it comes with a lag, and that lag is a good 3 to 4 years. So this process of a widening deficit has been in place for at least 5 years. So we're quite headlong into this process. So that 10% depreciation that we saw last year, maybe just the starting of that structural decline in dollar. Added to that, we've got these issues around um, worries about Fed independence and worries about how much support the current government in the US will provide the dollar if you see natural forces of weakening. If the current administration aren't willing to lean against the wind, so to speak, with the dollar declines, that may help accelerate a dollar depreciation as well. So I do think over the next few years we're likely to see more dollar depreciation, which will be supportive for commodities, as you've established.
Excellent. Yeah, very, very interesting. And now when we look at the current economic cycle, right, I have the feeling it's going on for quite some time now. Where do you think we are currently in the cycle, and what does that mean for commodities in general?
Yeah. So the last recession we had was during the COVID crisis. So and that was a relatively short and sharp recession. The rebound was pretty strong there afterwards, but we've been over 5 years into that recovery period. So arguably, we are very late in this economic cycle now. And as you discussed earlier on, um, equities and commodities, both cyclical, but are operating different points of the cycle. Equities um, tend to perform really well earlier on in the economic cycle, whereas commodities tend to provide their best performance late in the cycle. So, if we're late economic cycle, this should arguably be the best times for commodities. And, the early part of this year has already illustrated that commodity prices can rally very strong in this kind of environment. So, maybe that's the early part of this year is the flavor of things to come, and we could see continued strength for the course of this year.
Yeah, that is great to hear. I like to hear that. And when I look a bit closer into that rally, I definitely see that precious metals play a big role. So They were really strong last year, and this year they seem to have started strong again. What's behind that? What's the reason behind that?
Yeah, I'd say there's multiple forces behind precious metals. And gold, I guess, sits at the center of the precious metals group, with other metals having some degree of correlation to gold, but also having some maybe industrial factors that support them. But let's focus a little bit on gold. And I'd say there's one of the key drivers for gold this year has been geopolitical risks. There are multiple wars ongoing. Russia, Ukraine one. There's been tensions in various parts of the Middle East. But they've been ongoing for a number of years. Um, but starting this year, we saw um, an attempt for regime change, I guess, in Venezuela. That's been certainly supportive for gold prices because of the elevated geopolitical risks that come from that. Um, I guess the Trump administration's attempt to get control of Greenland um, was, heightened geopolitical risks. It took Trump a while to clarify that he won't be using force, and it took a while for him to sort of step down from using sort of tariff threats against countries that are supporting Greenland. So, that elevated geopolitical risks. At the moment, there are discussions on uh, you know uh, on de-risking Iran from nuclear. Now, every bump in the road that we have on those negotiations and those discussions tend to elevate geopolitical risks. So that's very much there in the gold spectrum. Um, then there's this aspect of fiscal dominance. I think that's supporting gold prices. And what I mean by fiscal dominance is when debt levels become large, and we've already discussed there's uh, forces behind increased debt levels, as in when deficits increase, they contribute to higher debt levels. Um, and it's not just in the US, but globally. Um, there is that risk that it makes financial markets unstable. Um, when governments are paying more on their interest payments than they are on, military and defense, that becomes a bit of a worry point. So high levels of indebtedness can cause financial market instability, and central banks they wear many hats. Obviously, inflation control is their main mandate, but in the case of the US, they're also in charge of labor market stability, but also financial market stability kind of falls in their remit as well. And if there is a risk of financial market instability from high levels of indebtedness, they may have to act preemptively. So, in some ways, fiscal policy, which can lead to large indebtedness, can drive monetary policy because that's what central banks are in charge of. Central banks may have to loosen interest rates or reduce interest rates or loosen monetary policy more broadly, maybe through quantitative easing or other processes. So fiscal policy can dominate monetary policy. Now, the problem with that is that um, loosening monetary policy tends to increase currency supply, debasing currencies, and therefore gold, which is the almost the antithesis to um, fiat currencies, could benefit from that, and that's why gold prices have been increasing. Those concerns about central banks acting, preemptively, um, are compounded by worries about central bank independence and the very direct attacks that the Federal Reserve has had from the Trump administration. Um, clearly, make that risk a lot more profound. So, the Trump administration's attacks on uh, Governor Powell, Chairman Powell, sorry, but also trying to remove Governor Cook from the board as well. There hasn't been helpful. Um, I think the nomination of Walsh as the for the next governor has calmed the markets, and that's when Walsh was nominated, that's where we saw the peak of gold prices, and gold prices have come down since then. But any further um, weakening or perceived weakening of Fed independence could contribute to more further upside on gold prices. Um, and so, those are some of the things that have been driving gold prices. And I think, lastly, we've talked about the dollar already, but that weakening of the dollar and maybe a lack of any indication that the Trump administration will push against it, lean against the wind, have also contributed to higher gold prices. And everything else has moved up in tandem with that. Silver as seen as almost a leverage play on gold, with a bit more sort of industrial demand, and the fact that it's in a supply deficit has also been supported with that gold rally.
Yeah, thank you very much for that explanation. And I can imagine that many of your listeners have observed the strong rally in January, right? I was glued to my screen when watching the prices towards the end of the month. So what do you think of that rally? And do you think it was just an overextension? What do you think?
Yeah, I mean, I think the proof is in the pudding, really. The fact that the gold prices aren't still at 5,600, and silver prices aren't still at 120, indicates that prices did get maybe a little overextended at that point. The pace of the increase certainly did seem alarming, and the fact that prices seem to have cooled down um, around the same time of, well, won the Washington nomination, but um, uh, in addition to that, the fact that we're in the Lunar New Year celebration period in Asia, particularly in China, may have taken off some of the traders from the market. Does indicate that maybe there was a little bit of speculative overextension during that period, but having said that, the fundamentals for gold and silver do remain quite firm. So I do think we will um, see price increases during the course of this year as those fundamentals assert themselves. It was just the pace of gains during that month did seem somewhat excessive. So I think there's potentially maybe good entry points being opened up right now with that pullback that we've seen since then.
Definitely. And in general, now when we think about the year ahead, what are your highest conviction views in commodities in general?
Yeah. So we've talked plenty about the precious metals, but I think the base metals may flourish this year. Um, if you look at base metals, their demand traditionally has been in industrial activities. I'm not saying that industrial activity is going to go flying through the roof this year, but we've got an accommodative, uh, policy environment, behind us. Relatively low interest rates, and plenty of fiscal support. Um, but beyond that, base metals are seeing increasing demand from uh, energy transition, or more accurately, energy addition, right? The growth in demand for renewable sources of energy, um, which tends to be very metal supportive. Um, the transmission cabling, the distribution cabling that's needed to push electricity around, the wiring that's needed in vehicles, the wiring that's needed in data centers. They're all very, very supportive for base metals, and as a result of that, I think that base metals will do well. But at the same time, the supply of those base metals um, aren't growing. Um, if you think about the copper markets, we've had a number of supply disruptions. The Grasberg mine, in particular, um, in 2025, the disruption to that mine is ongoing. We won't get back to full capacity until 2027. In the aluminium markets, the capacity constraints that China has put on in aluminium smelting, they're becoming quite constraining right now. So copper, aluminium, tin, I do believe are going to be some of the strong moving commodities during this course of this year.
Very interesting, and I think that makes a lot of sense in the current context. Um, Now, thinking about the more, let's say, traditional applications of commodities, and I think about oil in particular, right? Oil last year has rather seen a weak year, right? Now, starting with 2026, I didn't expect to see such a rally. I think the Bloomberg Commodity Energy sub-index is up by 10%. So what do you think about that recent rally in oil prices? Is that something which is supply driven, demand driven, or is there some kind of risk premium embedded?
Yeah, so if we look at oil demand, um, it's growing, but not nothing spectacular. There is that energy addition, so we're not reducing our oil demand for sure. All the renewable sources of energy demand are being stacked on top of existing demand for hydrocarbons, including oil. But it's not that, so the oil demand is not decreasing, but it's not growing very fast. um, if we look at the supply side, it looks like there's plenty of oil around. We're overproducing globally, um, and even though OPEC, the organization of petroleum exporting countries, and their partner countries, have put a pause on their production expansion in the first quarter of this year, there's still too much oil being produced, and the inventory is large. Mainly the inventory sitting out there in China, which is less visible and less transparent, but there is a lot of oil sitting out there in China not being used. So supply is uh, too high, demand while growing is relatively weak. Yet we're seeing oil prices increase. I think the reason for that oil price increase is um, a geopolitical risk premium. As I mentioned earlier on, there are those nuclear discussions ongoing with Iran. And the risk at the moment is if those negotiations go sour, um, there is potential for oil supply to come off from Iran. If US were to use means of force in Iran, that could hurt. The US has increased its military presence in the Middle East in a similar way to increase their military presence in the Gulf, prior to their the Venezuela episode. So that is putting markets at unease, and people worry about oil movement around that region. There is a very important um, oil transit point near Iran, the Strait of Hormuz. It's actually the probably the world's most important so-called choke point. Um, Now, I think Iran would be foolish to disrupt oil moving around in that region, because it would create enemies from every one of its neighbors, or I mean, even more so than maybe the case at present. But there is that risk. An accident could happen, and if there is an accident, that could choke off all the supply from that region. So I think that's being priced in at the margin into oil prices at the moment. And yes, we don't have oil prices, in the 90s or in the hundreds right now, but Brent back above $70 a barrel does indicate some pricing in of these risks. Now, should things de-escalate in the region, with should these negotiations go better, then clearly there's a lot more downside risk to oil prices given the plentiful supply.
Yeah, excellent. That makes so much sense. Yeah.
So we've discussed a lot about the case for commodities. Um, Toby, maybe turning tables back to you. How should investors think about implementing a position in commodities if they agree with our case for commodities? Um, Maybe we could talk a little bit about the various ways to access commodities. Physical supply, or going into commodities physically, or through futures markets, or even equity markets. What are your views?
Yeah, absolutely. That's a great question. Now I will explain this in two parts, right? The first one is from an allocation perspective, right? We agreed before that the majority of returns are usually explained by the asset allocation itself, right? The split between the asset classes, equities, bonds, commodities, crypto, right? Like all the different asset classes. Now, if you think about starting to invest into equities, right? If it's your first foray into equities, you would typically start with a basket, right? You would not pick individual stocks. You would pick a index like the S&P 500, the MSCI World, like a diversified baskets, because that reduces risk while you still get the risk premia. So here it's similar. A broad basket makes a lot of sense. So broad representation is key to begin with. Um, Second, there are plenty of UCITS ETFs out there which are already providing that exposure. So for an investor to get exposure to commodities, actually fairly simple, right? It's a liquid tradable instrument, tradable throughout the exchange hours, and it's really cost efficient, right? Now, if we drill down on how ETFs achieve that, right? How it's so simple to get a commodity into an ETF, and we have to understand investing into commodities first, because now, even though commodities are real physical assets, you can't easily invest physically in many commodities because they are either perishable, like agriculture, like wheat, for example, or they're really bulky, and it's hard to have enough storage facility. What this would be the case for aluminum, right? So the common practice in the industry, or like in these ETFs, is to create synthetic position. So that basically means establishing a constant futures position. So that's a contract for future delivery of the commodity. And if we post collateral to the full notional of that exposure, then we closely track the spot price of the commodity itself. Yeah? So a little bit of financial engineering here that achieves that. And now, for example, we spoke about gold and silver already. These are exceptions because these are very dense metals, and there's a market established for physical storage. So there are many ETCs, and I think many of your listeners probably already use such ETCs, where the metal is stored in vaults in London. And here in London, we have a really highly efficient market, hundred millions or hundreds of tons. I'm not sure how many, but like definitely a lot of gold stored here. And so the storage is highly cost efficient in that case. So what we do at Wisdom Tree in our broad commodities is that we say, okay, those commodities which we need to replicate synthetically because they either are too big, perishable, etc. So we do that with futures. Now, where we can store commodities physically, in the case of gold and silver, we do so.
Excellent. So, these commodity indices, who decides what goes in them? What are the sort of factors to consider whether a commodity should go into an index?
Yeah, absolutely. I mean, it's very similar again to equities, right? We have for example, the Nasdaq 100, the S&P 500, MSCI World. I mean, there are certain rules why certain stocks are included in these indices, and so do we have rules in commodities. And these are not arbitrary, right? They exist for a reason, and the reason is that we want to create a significant and a liquid product, right? So if we start with um, liquidity, right? The ultimate purpose is to create an ETF which you can trade in large volumes every day. It needs to be liquid, and so if we think about commodities now, there needs to be a commonly accepted benchmark price for a specific commodity, and then there needs to be a futures market with deep liquidity. Um, and for example, if we think about crude oil, right, there are many sorts of crude oil. There's many different varieties, qualities. I was reading even the same well on a given day can create different qualities of crude oil. And so how do you price that? And in oil, they do that with two benchmarks, the North Sea version, Brent, and then the West Texas intermediate price. And so to both benchmarks, there's a liquid futures market attached, and hence we can get exposure via futures to these commodities. Without this commonly agreed benchmark, it would not be so easily possible. Now, the second part is economic significance, right? Because we want to have broad representation, right? Um, a commodity needs to be produced in big volumes so that it's really significant or relevant for the global economy, because that's ultimately what we seek in a broad commodities index. So these two things are guiding principles when it comes to broad commodity indices. Yeah.
And I guess it's not a static picture, right? That some commodities, they their liquidity improves over time, and they become something that becomes, they become eligible for an index after not being eligible for some time. Um, I think last year, this year, we've seen the inclusion of cocoa, for example, into some of the broad commodity indices like Bloomberg commodity indices, and I guess our wisdom tree equivalent versions of of that index. I guess it's nice because we're all seeing the pinch in our wallets from having to spend a bit more on on cocoa and chocolates,
Yeah.
especially as Easter rolls around. So that could be a nice thing to protect us against the inflation from higher chocolate prices.
Yeah, absolutely. I mean, in the end of the day, it's about representation, right? We saw cocoa being added to the index, relatively small weight, 1.7%, but it just gets to show how close such a broad commodities index is to our real life experience prices, right? Cocoa prices have been really skyrocketing over the last couple of years because of different conditions in the harvesting of that commodity, right? I mean, cocoa is basically harvested in this narrow equatorial belt and just a few countries, right? And so weather disruptions or diseases to the plants can really destroy a harvest. And now at the same time, we love to consume chocolate, right? Like in Europe, like I was reading on average 6 kilograms per year. Like I'm not sure where your consumption sit, but it does seem a lot to me. But yeah, so it just helps to link the commodity index even closer to inflation at the end of the day.
Well, and so we talked about these indices with different commodities in, um, but typically, I guess the generation one of a lot of these indices uh, were positioned in around the front month sort of contracts. Now, just giving a little bit of sort of background to our audience. When it comes to futures market uh, in commodities, well, in any asset, um, there is this aspect of roll drag to maintain a position in any given future on a rolling basis. You need to keep continually rolling the contracts as they come to expiry. The problem with that is that when you have these markets which are in so-called contango, you have an upward sloping futures curve. If you're positioned, say, a few months out into the curve, through the passage of time, as that position becomes closer and closer to the spot, assuming there's no change in the shape of the curve, we could see the price of that commodity uh, or that contract decline. So that represents a roll drag. Conversely, when you have markets are in backwardation, which means you have a downward sloping futures curve, where the price of a commodity for delivery in a few months' time is lower than the price uh, for delivery immediately. And if you assume no change in the shape of the curve, as through the passage of time, the price of that commodity or that contract could increase. So there is these dynamics that people have to worry about when investing in futures curves. So tell me a little bit about how we can construct indices and products that may play on uh, either reducing these roll drags or amplify them when you have that positive role enhancement. And what other things can we do to these indices to make them better than these so-called first generation indices?
Yeah, exactly. And I think that's a fair point. Yeah, many of these first generation indices are associated to a rather big roll drag. And yeah, I mean, commodity markets, um, under the surface, there's really a lot to it, right? There's seasonality, like winter, summer, there is the different harvesting periods of commodities. So even just not considering such effects like seasonality, just rolling your contracts through harvesting, growing period, or through winter, autumn, summer again, this creates roll drag a lot. And so you can, if you think about seasonality, you can already do a lot to avoid um going through this up and down of the future curves. So that's one thing. But in general, when you think about the futures curve, right, we also have to think about the different market participants. Now we have consumers, we have producers, we have speculation, we have the long only index investor, right? Who typically sits at the front of the curve, right? So this creates different realized cost of carry of such a long-term holding, depending on where you're positioning yourselves on the curve, because the market participants are changing the curve, right? In general, we think of the curve as contango, right? Because there is this reflects storage and insurance costs, net of convenience yield. And so we would expect a straight line, but the reality it's not a straight line. It's really more like a concave shape, right? So the slope changes. It's not a straight line, and so that basically gives you room to optimize, right? What we typically see is that the front of the curve has a higher cost of carry, and at the third end of the curve has a rather lower cost of carry. And and this really depends on the shape. And if you have like a flexible algorithm behind that, you can position yourself on the curve to really like let's say lower the cost of carry. There will be a cost of carry, but you can at least like manage it. You can lower it. Um, and maybe the last thing when we speak about the the um yeah, the different factors, so to say, in commodities, we also have to mention momentum, right? Because we spoke about the cycle earlier, right? There's this some people call it boom and bust. And so the different legs of that commodity cycle can be observed, and during different legs of that cycle, um, prices can trend, right? And so if we um, deploy a smart momentum model, right, which can see like, oh yeah, this commodity is trending right now, it seems to be in that part of the cycle. Now, if we then change weightings according to that, we can also improve returns. And so there's this host of newer generation commodity ETFs which account for such dynamics. And yeah, and as you mentioned, at Wisdom Tree, we know all of this. We consider that. We observe it, and so we also have some commodity ETFs which I think are the best of these new generation ETFs, which all consider these interesting dynamics.
Thank you so much, Toby, for sharing your valuable insights with us. You can track all of Toby's research on our website. And great, thanks everyone for tuning in. We hope you've enjoyed today's episode of the Commodity Exchange. If you want to hear more from us at Wisdom Tree, please do subscribe to the Commodity Exchange on whichever platform you're using, YouTube, Spotify, Apple. You can follow me on X, formerly Twitter, with the handle @Nitesh Shah WT, and on LinkedIn. And if you want to learn more about commodities, please do visit Wisdom Tree's website, where we have a wide range of research materials. Until next time. I do need to state the following. To clarify, the views and opinions expressed in this podcast are those of Wisdom Tree and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results.